We are thrilled to bring you today James Sweeney of Credit Suisse. He wrote an exceptionally important paper 2.5 years ago on deflation, and he recapitulated that yesterday for Credit Suisse. What did you say in your report yesterday?
Well, that the Fed was correct to describe the recent weakness in some inflation measures as driven by temporary factors. So we think that inflation is naturally going to drift back up in the coming months. And if the trade war intensifies, then as we see some pass-through from import prices from China, we could have a little bit of an overshoot in inflation. So economic growth is slowing, but inflation is likely to be rising, is unfortunately the message.
Okay, let's go back to the history of Stanley Fischer, the vice chairman, not that Fisher spelled differently, Irving Fisher of Another Time and Place. Link all this together for us. You're saying deflation way overdone, so is Chairman Powell, I suggest Vice Chairman Clarida as well, and yet I've got price up, yield down, and I'm looking at the foreign exchange market mirroring off that. How Irving Fisher are we right now?
You know, I would almost separate inflation from that conversation. Inflation's a slower moving, lagging variable, and actually for the last 25 years, it's gone pretty much nowhere. It's been, 1.7 has been the average core PCE inflation rate since 1995. The market is moving for other reasons. The market's moving because of the trade war, because of growth concerns, because U.S. manufacturing has been slowing, has in fact been contracting over recent months. And some people are, extrapolating that weakness all the way out into a recession, expecting multiple Fed cuts, et cetera. I think all eyes now really are on the labor market and whether you could start to see some weakness in U.S. jobs and rising unemployment and all that. So far in things like initial claims, you don't see that weakness in the labor market. But inflation is just a different thing. It's just a different thing.
Right.
And it's likely to go up rather than down in the near term, whether growth is weak or not.
James, does the U.S. have a dollar problem? Is it too high?
It's a modest problem. I don't think. If you look at goods prices in the U.S., goods prices, meaning the non-services, non-energy component of inflation, they've come down a little bit recently, but essentially they've been very steady in modest deflation for a very long time. So the tradable sector, import inflation and dollar-driven disinflation has not been a major driver of this decline in inflation that we've had recently. It's more been a factor that you've had over time.